Good afternoon, and thanks for joining us. My name is Steve Halverson, and I'll be leading our discussion as we look back on our first pay versus performance proxy season and discuss what we learned and what we might do in the future. I'm joined today by two great experts, Jan Kors and Adam Cayley of Pearl Meyer. They've done a lot of work on this and given a lot of thought to the topic, and they're going to walk us through an important presentation. You will see a comprehensive review of the initial proxy data and outline some of the trends that emerged. We'll talk about discussing pay versus performance with investors and stakeholders and what we've learned in the first round of conversations with them. As you might expect, much of the dialogue on the new pay versus performance disclosure is about what it doesn't tell you as much as what it does. We have a lot of content to cover today, but we'll make sure that we allow some time for questions at the end. But before we dive in, let me turn to Mari Canizales with NACD, who has a few housekeeping items to note, and then Adam will kick off our presentation. Mari?
Thank you very much, Steve, and welcome everyone. I'd like to go through a couple of housekeeping items, as Steve mentioned, before we go ahead and get started. The first is we'd love to hear from you. We know that there's a lot of great content, and I'm sure it'll bring up a lot of good questions. And so we just ask you to go ahead and submit those questions throughout the entire webinar into the Q&A section of the portal. We've built, as Steve mentioned, a little bit of time at the end for Q&A, but Jan and Adam are willing to answer some of those questions that are relevant during the presentation in certain areas while you're asking them. So please feel free to go ahead and submit those questions in the Q&A. And then if we, for some reason, we can't get to your question, whether we've run out of time or, we'll just go ahead and respond directly to you in the next couple days via email. The number one question we always get, no matter what, is whether the webinar is being recorded and if slides are going to be available. So yes, the webinar will be recorded and will be available online, both on nacdonline.org/webinars and on pearlmeyer.com at the website you see below. You can also access the presentation slides and additional great thought leadership content right in the additional resources tool, and they will also be available in those post-webinar emails. For our certified directors and our board director fellows, your participation in today's webinar does provide you one NACD credit. You'll automatically receive this credit for participation, but you must attend at least 50 minutes of the webinar to receive that credit. So speaking of our certification program, if you are not aware of it, feel free to find out more information at the link. This designation is a wonderful way to do just a lot of more learning and setting yourself apart as a high performance director. Contact your membership advisor at Credentialing at nacdonline.org. Finally, we have a few evaluation questions that we'd like to ask at the end of every webinar. We hope that you'll stay and provide feedback. It really helps us provide insight of how we can improve our webinars and those topics that you'd like to hear more about. So with that, I'd like to turn it over to Jan Kors of Pearl Meyer, who'll go ahead and get us started. Jan, welcome.
Thanks, Mari. If we can just flip us to the next page, please. So as we say in the title, we really want to spend this time talking about what we learned from the first round of disclosures, as well as what we do with all of this new information going forward. But we are going to start with just as a reminder of what the rules are, what the disclosure looks like, just to level set and be a reminder for everybody. Then we'll talk about the trends that we've seen in the disclosure, as well as some recommendations for what you should do with all of this data when you're back in your comp committee rooms. So we'll do a start off with a quick review of the new rules, the additional charts and graphs that got disclosed, and then move into trends. So if we can go to the next page, and we'll just kick it off with the rules. So a refresher of what those rules were. Next page. As you know, this is one of the last remaining pieces of the Dodd-Frank Act. So we are, more than a decade after Dodd-Frank was adopted, we finally got these rules. It created quite a bit of a scramble the tail end of 2022 because while the rules were not adopted until the end of August, they required compliance for companies' 2022 fiscal years, which meant it had to be done in the 2023 proxy statement. And much of the data was things that were not already resident somewhere else in the company. This was more than just an exercise of compiling data that existed. It meant doing new calculations and new analyses. So it was a very compressed implementation timeline that caused companies and HR teams quite a bit of angst during year one. We would expect that it will be much cleaner and simpler going forward now that everybody understands the process. But essentially what the new rule required was a disclosure of compensation actually paid. That term is important because that's the term that was in Dodd-Frank, and it is the term that the SEC adopted, but we'll talk more than once about how that's not exactly what the data shows us. And then it required a disclosure of the comparison of that compensation actually paid to the company's performance. And so the easiest way to show you how that all played out is to actually go to the next few pages and show you the tables that are required. So if we can go to the next page. So this is the primary PVP table, and you'll see it started this year with 3 years worth of data. In subsequent years, next year we will add a 4th year of data. The following year we'll add a 5th year of data. And after that, it will be a rolling 5 years of data. The first 2 columns are the summary compensation total. So that's taken straight from a summary comp table that's already in play, that's already in the proxy. And it compares it to the compensation, this new compensation actually paid calculation for the CEO. If you have more than one CEO during that 3, 4, 5 year period, you need separate columns for each CEO. And then you see 2 sets of columns, the same summary comp table data and compensation actually paid data for all of the other named executive officers, but in aggregate, they get averaged together. So those 4 columns make up the pay side of the pay for performance table. And then we move to the last 4 columns, which are the performance side of the pay for performance table. You've got your total shareholder return over that 3, 4, or 5 year period. And then you've got a relative total shareholder return. So who are you comparing yourself on a peer group basis? And this is one of the places where companies had a little bit of leeway to make a choice about do they use the peer group that they identify in the proxy for their compensation comparisons, or do they use the peer group in their 10K that is in the current total shareholder return chart? And we'll talk a little bit in a bit about how that played out in terms of prevalence of choosing one or the other. And then the last 2 columns are, again, company numbers. So the net income for the company, that is GAAP unadjusted net income, and then a company selected measure. And here again, the company had some choices in terms of the metric you chose, but it's supposed to be the measure that is most impactful on the compensation actually paid number to the left. what we found in that, and here again, a bit of a misnomer, because when you end up looking at the data, the thing that drives compensation more than anything, the CAP number, is stock price performance. And you are only allowed to use stock price performance or total shareholder return or metrics of that ilk if in fact it is an actual metric in one of your incentive plans. So companies did the best they could in selecting that measure. And again, we'll review kind of where that came out in the data. Next slide. So compensation actually paid. It's not really compensation actually paid. You take the summary comp table data and you make adjustments. You make adjustments for pension plans for anybody who still has a defined benefit plan. You make some adjustments for deferred compensation and then the biggest adjustments are in the equity space. And essentially, we lay out here kind of how it works mechanically, but essentially what you're doing in the equity space is you are exchanging the grant date value that's in the summary comp table for the fiscal year end value of anything that has not yet vested, as well as the vested date value of anything that did vest during the year. So it's kind of the easiest way to think about it is kind of a mark to market on your outstanding equity awards. And as you might expect, given the stock price performance market in general over the past 3 years, that calculation and comparing it from year to year created some wild swings in the data. Next page. The other thing that took folks a fair amount of time, and here we're actually using Steve's company example that took folks a fair amount of time to get their hands around, is there is a requirement to provide in the footnote that reconciliation that gets you from the number that's in the summary comp table to the number that is the CAP. Here is a horizontal reconciliation. You go from summary comp table at the top, you see all the pluses and minuses to get you to the compensation actually paid number at the bottom. And that is from the company where Steve's the director at CSX. On the next page, you'll see a vertical example of the disclosure where you go from summary compensation number on the left-hand side, and you walk across the page to the CAP number on the right-hand side. Either one is acceptable. I think the takeaway is that you can't just sort of say, we started with this number, we added or subtracted that number, and we got to an end number. You actually have to show all of the puts and calls, if you will, to get you from point A to point B. Next page. In addition to that chart, there was a requirement for companies to explain the relationship between the CAP, the compensation actually paid, and the company's performance. Most companies, and again, we use CSX as the example, most companies chose to do that in graphical form, that a picture is worth 1,000 words, and the proxies are already wordy enough. So most companies chose to do it in the form of a series of graphs rather than a long narrative. Again, we'll talk about this when Adam goes through the results, but in general, we did not see a lot of narrative around this portion of the disclosure. It was mostly pictures with as little explanatory information as companies could get away with. Next page. So again, you know, just as a highlight about the things that have to be footnoted, you have to list, you know, you don't have to show the data for each non-executive officer separately, but you do have to list who those named executive officers are in each of the required 3 years or 4 years or 5 years. If you are not using a published index for the relative total shareholder return comparison, you have to list the companies that comprise the group you do use, as well as list any changes in that peer group composition from year to year. You have to do the detailed reconciliation. We showed you a couple of examples of that. And then if for your company selected measure, you chose to use a non-GAAP measure, as many companies do. If you think about the metrics that are in many companies' incentive plans, they are adjusted EBITDA or adjusted income. And so if you make an adjustment from a GAAP number, you have to show that reconciliation as to how you got to from GAAP to your company selected metric. Next. So as I said when I started, this first year was a bit of a challenge. Equity valuations were very hard, not because we don't know how to do it, but because the idea of doing a new valuation for in-flight equity is not something that we've typically had to do before. So that created a bit of a challenge. Anything that had a total shareholder return metric or a stock price metric for PSUs, you had to do new Monte Carlo valuations, which created both incremental time as well as incremental cost. And then obviously, multiple CEOs require extra disclosure. The issues around equity acceleration for terminations or severance create incremental disclosure and complications. So this first year was a challenge for people. And Steve, I don't know whether you have any kind of insights from what you heard from your management team as they were in process on this.
Yeah, thanks, Jan. About what you would anticipate, took a lot more time than we expected, primarily around the valuation of the in-flight equity awards for all the reasons that you state. And I guess our sense was, like anything new, it takes twice as long the first year. We anticipate now that going forward, it'll fall into the manageable range in year 2 and beyond.
Great, thank you. Next page. So I'm now going to turn the baton over to Adam and let him talk about what did we see in the proxy postmortem.
Thanks, Jan. So we tabulated results from what we saw among the Russell 3000 companies, and we set the cutoff date as of the end of May. So in here, we'll share results from the Russell 3000. In terms of that company selected measure, we've gone a little more in detail to a smaller sample of the S&P 500, just because there was less noise there. So we'll show you those results as well. So we'll talk about measures. We'll also talk about what did we see in terms of this pay versus performance relationship. Do we in fact see that there was some sort of relationship when you look at the broader data set? So if you move to the next slide, this is an overview among that Russell 3000 of what companies chose as their company selected measure and as their other measures. So in addition to your company selected measure, you've got to create a table of 3 to 7 other measures that you believe are correlated with your compensation actually paid. So among the Russell 3000, about 80% of those were full reporting companies. So they were not small reporting companies. 20% of that sample were smaller reporting companies. So in terms of the other results you see here, we'll focus it on those full reporting companies that had to disclose a company selected measure. As Jan mentioned, most companies used a non-GAAP measure. About 84% of companies chose a non-GAAP measure. In other words, we're using some sort of measure where there are adjustments. And that makes sense because most companies decided to use a measure in their annual incentive plan or performance share plan. And most companies are using some sort of adjustments in that measurement, in that metric. Interestingly, a number of companies decided to disclose more than one or disclose two company selected measures. About 2% of that sample, about 43 companies, did use two CSMs, which is interesting because the rules only required one. And as we dug into the data and looked at examples here, it happened to be companies that may use a balance of measures like top line results and bottom line results. And as we think about it, those companies probably truly believed that both of those measures correlated with CAP over time, and it made the most sense for them to disclose two. Lastly, in terms of those other measures, 91% of companies chose financial measures in that other list, but there were about 9% of companies that did decide to disclose some non-financial metrics. If you move to the next slide, what did the disclosures look like? So in overall, what was the length in terms of word count? How many charts did people use? And what index ultimately did they select as their TSR index? The average word count was around 1,400 words. And when you translate that into pages, we're looking at about 4 to 5 pages once you include the text and the charts. So this added a fair amount to the proxy statement in terms of overall length of the disclosure. But some companies, as you see, the max there was about 7,400 words. So some of these disclosures got fairly lengthy. Most companies chose 3 charts to describe that pay versus performance relationship. And we think, that was kind of the overall kind of best practice in terms of demonstrating the relationship. And then most companies disclose about 4 other, non-ranked metrics, or those other metrics. Now, in terms of the peer group that was used, this, was a difficult process for companies to decide, should I use a published index? Should I use my compensation peer group? Should I use the peer group that I compare myself to in the PSU plan for TSR purposes? And there's a debate among companies, committees and experts on what was best to use. Ultimately, most companies decided to use an industry specific index, the same index that was published in their 10K performance graph, for a number of reasons. And one of the largest reasons was, to the extent you use a compensation peer group or performance peer group that is not a published index, and to the extent that index or that peer group changes every year, you have to recalculate your TSR for each of those years every year you do it. And practically speaking, most companies are evaluating their compensation peer group every year, changing peers to the extent that there have been M&As, that there's been changes in the business. So most companies went the kind of the more safe route, decided to use the industry specific index that was in their 10K. On the next slide, we have a little more information on what types of company selected measures were used. And this again focuses on these larger companies in the S&P 500. And we organize this table in the way that you'd normally see things ordered on an income statement, starting with revenue, going down to profit, et cetera. There's a lot of information here, but the high level information to take away from this is that the CSM that was most common in terms of the category of measurement was a profit metric, where about 55% of companies chose a profit metric. Next most common was revenue at 18%. Then returns or ratios at 12%, cash flow around 5%, and then TSR, and finally other. What's interesting is there are some industries in which there is a trend that a lot of companies within that industry were using that CSM. And as you look at the type of industries that you see here and the types of metrics that were being used, it makes sense. And it just goes back to the point we were saying that most companies chose the most heavily weighted measure in their annual incentive plan or performance share plan. So this gives you some idea of what companies used. Now, Steve, as you think about the committees that you work with, sometimes there was a level of debate among the committee members and management in terms of what's the right CSM to use for the company. What was your thought process and the boards that you worked on in selecting that measure?
Yeah, thanks, Ed. And we spent a lot of time on this topic. The advice we got was not different than what you see there. Pick one metric only, and pick whatever is the most heavily weighted metric out of your short-term plan. We did disclose for a company selected measure just one metric, but we used a different one, it's called, we call it CSX cash earnings, which is an EVA measure that measures return over a implied value cost of capital. And the reason we chose that is it was most closely correlated to strategy, which CSX is pivoting away from a operating ratio or operating effectiveness strategy to a growth strategy. And it most closely correlated to total shareholder return. So we thought it was the best answer, but we clearly were an outlier. It's a ratio, and it's not even a very conventional ratio, but that's what we chose and why we chose it.
Great, thank you. So on the next slide, we have looked into the results of the actual numbers in terms of what we saw between the compensation actually paid number and total shareholder return. So the question we're trying to ask here is, among the Russell 3000, did we see a relationship between CAP and TSR? Now, when we first looked at this, we tried, comparing compensation actually paid to TSR and doing a scatter plot. What's interesting when you do that is you don't see any meaningful results. It just looks like a messy scatter plot. The R squared is very low. There's really no relationship. But what we found is you have to look at the relationship between CAP and summary compensation table pay. Look at that ratio relative to TSR. Because CAP shows, that kind of normalizes things. And if you think about the companies in the sample with a wide range of revenues and industries, that's a way of normalizing the results. So the numbers you see here compare that ratio of CAP as a percentage of summary compensation table pay versus TSR. On the top right chart, we've shown it over a 3-year cumulative basis. And interestingly, at the median, the middle red bar there, the CAP as a percentage of summary compensation table pay was 5% for the PEO, also known as the CEO, 4% for the other NEOs, and then the median TSR was the same at 4%. You'll see there's quite a range from the 25th to 75th percentile there, but overall on that 3-year basis, you see a strong relationship between this ratio between CAP and SCT and TSR. The results on the bottom break it down to the annualized TSR and the CAP versus summary compensation table pay in each year. And it's interesting to look through this and think about what happened in each of those years and why we saw those results. So if you think about 2020, it was the height of the pandemic. There were a number of companies that were struggling in terms of TSR and performance during that period. On the other hand, there are a number of companies and industries that were doing very well. So when you look at the range between the 25th and 75th percentiles there, it's not surprising to see that there's a big range in TSR, but there is also a big range in that ratio between CAP and summary compensation table paid information. But again, at the median, we saw that ratio right in line with TSR. Same for 2021. 2021 was a year where there's a big recovery from the pandemic. Very positive TSR at the median, and also, CAP on average or at the median was much higher than summary compensation table pay. Now, if you look at 2022, during a bit of a downturn, TSR by the end of that year ended up at negative 16%. And at the median, most companies had CAP that was less than summary compensation table paid in that year. Even a number of companies disclose CAP that was a negative number. So that's another trend that we saw that was as a result of the way the rules work. You can have a negative compensation actually paid number, which kind of brings into question the whole concept of CAP. So interesting results. We did see a good degree of relationship, and I think going forward, we'll continue to evaluate this ratio between CAP and summary compensation table pay and TSR. So if you move on to the next slide, what did we learn from all this? Reviewing all the disclosures, thinking about how we worked with our committees in developing this, what are kind of some guiding principles for developing some best-in-class PVP disclosures? Throughout this process, from the very beginning, we viewed this as a compliance exercise at Perlmutter and advised clients that the mantra is less is more. To really comply with the rules, just to the extent you can, display information graphically, and clearly footnote the assumptions that you're making, et cetera. Most companies, as I mentioned, decided to do just 3 charts: CAP versus net income versus your CSM and versus your TSR and versus the peer group TSR. The vast majority, about 90% of companies, simply did that and did not provide additional narrative. That other 10% of companies that only provided narrative may have been companies in which there was a tenuous relationship between CAP and TSR, and often they're advised by their counsel to go into some detail describing the reasons why there may not have been a connection. But what we found, a number of companies that may not have good correlation, nevertheless just decided to do the graphs and let the results speak for themselves. One last thing to take away from this is we've been thinking about for next year and the upcoming years, what will be the impact of all of this? And ultimately, we think this has put a greater focus on pay versus performance, and it may lead committees to think about what are ways in which we can better describe in the CD&A, kind of more upfront in the CD&A, the methodologies, the tools that the committee uses to evaluate pay versus performance. So we hope going forward, we might see more companies talk about the fact that they use a realized or realizable pay analysis. They use tally sheets, those sort of tools to evaluate pay versus performance for the executives and the company. So those are the overall trends. In the next section, we've put together an example of what we've been doing with clients to evaluate their results versus peers. So if you move to the next slide, we've just shown you a couple of pages of how we do this. And a number of you may have been doing something similar with your committees. So in the next slide, we've shown an example for this is a specialty chemicals company that happened to have the highest 3-year annualized TSR among its peer group. They also had fairly high compensation actually paid, but even though they were far above the next highest peer, they were at the 92nd percentile. So first of all, what we recommend doing is just collect all the information from the peer group in terms of for each company, the SCT, the CAP, the metrics used, the indices used, and just get a sense of how did our results compare to peers. But what's even more interesting to do is on the next slide is to show an example or to plot out for the client versus the peer group, how you compared on those metrics. So you see the client on the rightmost side, they had a 3-year index TSR of about $180. The circle shows the summary compensation table paid data, and then the triangle shows the CAP. And this is a 3-year average for the CEO of the period. So again, you'll notice that the client, although they do have the CAP at the 92nd percentile, they're far out to the right there in terms of performance. So I think that the committee could be fairly happy with the results here. That versus peers, we're performing very well, but our compensation actually paid is aligned with that. So if you move on to the next slide, please. So there, are a number of ways that experts are trying to evaluate how do we make sense of all this. And, as I mentioned, you can't just look at CAP alone. You've got to look at that ratio between CAP and summary compensation table paid, or take the difference of the two. A lot of experts are saying, how much CAP in excess of summary compensation table pay was provided, and how can we look at that relative to TSR? One last thing is a sharing ratio. Let's think about this in terms of what results were delivered to shareholders over this time period. What was the total increase in market cap, for example, over that period? And let's think about expressing that CAP in excess of summary comp table pay as a percentage of the value delivered to shareholders over that time. And when you start to do these sort of analyses, you start to make more sense of the results and, trying to size your results relative to your peers or your industry. So next slide, please. So I think you're on mute, Jan. I don't hear you.
Sorry.
Yep. We'll kick it over to Jan.
No, I just wanted to say on that last point, I think part of the challenge in having this data at this particular time is that while we can do a lot of these analyses and comparisons, the performance side of the pay for performance equation has been so volatile the last 3 years because of the pandemic and the lingering effects of the pandemic on supply chains, on companies figuring out work from home, that, I'm not sure how helpful those comparisons are right now. Certainly not as helpful as I imagine they might be over time when, knock on wood, we get back to something that feels a little more normalized. But Steve, I don't know whether that was your take as you and your colleagues were looking at some of this volatility as well. Yep. Yeah, maybe. Oh, you're on mute, Steve. There
I'm sorry,
we go.
I didn't hear your question when you asked it.
I was just wondering, I question, even though we could do the math on some of these comparisons, like Adam was suggesting, that, I wonder how much usefulness they have when you think about how atypical the past 2 or 3 years have been from a performance point of view. And I don't know whether you and your colleagues had talked about, the utility of this data given the 3 years that it covers.
Yeah, it's a great point. And we did talk about it, but more importantly, we asked our shareholders about it. CSX has had a habit and a pattern of very, very extensive shareholder outreach. So we have a lot of conversations. And what struck me was this last season, out of 50 outreach efforts to our top shareholders and 9 personal meetings with them, not a single question arose about PVP. Nobody raised anything. And when we asked them about it, there was sort of a lukewarm response that didn't really give them much they didn't already know. So we asked them what they did want, and it was really kind of what you would expect. They wanted to tell them not just what we did, but why, what the reasoning was. They asked us to show data in graphic and tabular format, and to just show us how your pay practices align pay with the shareholder experience. And I didn't get the sense that they thought that the PVP was particularly probative of any of those questions.
I would say that's consistent with what I'm hearing from clients as well. All right, Adam, sorry. to sidetrack you there.
Oh, no worries. No, I think this, I was going to kick it over to you, Jan, for this last section. So in this next section,
Sure.
we prepared, some FAQs that you might anticipate getting from, shareholders, employees, et cetera, and how you might, prepare for that.
Sure. So if we can flip to the next slide. When we think about questions that particularly a compensation committee chair might get, as Steve was talking, when talking to investors or getting questions from employees in a town hall meeting or something, I think it's important to first kind of put this in its place in terms of how much relative performance you should or should not attach to the numbers. But I think it's really around being able to explain in plain English what this table is, but equally importantly, what this table is not. And talking about, for example, the fact that compensation actually paid, while based on the words might suggest that, this is what it was in the CEO's W-2 for taxes. That is not what it is. And being able to have an understandable discussion about what that number really represents. The other thing I would anticipate, particularly in industries where there has been some wide swings in volatility, is being able to respond to the question, did the CEO really make $20 million? But conversely, how is it possible that the CEO had a negative $20 million number? That doesn't make any sense. I think the other thing here that is important is being able to talk about the relationship of pay to performance and how the board thinks about it when it's making those decisions, irrespective of what the data in the tables say. And I think that, in some of the examples that I've seen from clients, they've actually referred people back to the CD&A where they talk about their compensation philosophy in a more comprehensive and thoughtful way. So basically the little header to the three charts or the three graphs is, we're putting these comparisons in here because the SEC told us we had to, but if you really want to know how we think about pay and performance, go read the CD&A. The last thing I would say on this page is that the impression that I've received from a few folks in the institutional investor community is that they are actually far more interested in the company, in that second chart, the chart that has the list of up to seven performance metrics. That to them, that is because that is a company that is entirely at the company's discretion, and because it can include non-financial metrics. I've been to some conferences and listened in on some calls where there's a sense that institutional investors are actually far more interested in the metrics that a company puts on that list of 7 than they are in the proscribed results of the PVP table. Any other thoughts about questions? I know, Adam, that you had just recently done a webinar covering the same material for a different constituency that was made up of all internal HR people. And I wondered whether there were any learnings out of what you heard from those participants.
Yeah, absolutely. So it was a presentation with World at Work, and those, it was comprised of HR professionals, compensation people who were involved in preparing this stuff. And we asked a few, polling questions. And one of the most interesting ones was the amount of time that this took overall. So when the SEC puts forth a new regulation, they always have to estimate the average amount of burden or hours it will take each issuer. And what they said was it's going to be about, 18 to 25 hours. We polled people, and the vast majority, 90% of people said it took over 40 hours. And we suspect, for some of them, it's 60 hours plus. So, we recognize this took a great deal of time, especially in this first year. We hope that burden will be less in future years now that, the methodology is in place and everything. The other thing was we asked people, did they receive any negative feedback on their PVP disclosure, whether it be from investors, employees, et cetera? And the vast majority said they didn't get any feedback. So it's kind of similar to what we witnessed with the implementation of the CEO pay ratio, where we expected that there would be a lot of negative reaction, negative media stories, et cetera. But we didn't see much of that with PVP, just like we didn't see it with the CEO pay ratio. But nevertheless, companies should be prepared. I think a lot of these questions are coming from employees that look into these big numbers, and they want to know, so the CEO was actually paid $20 million in the last fiscal year. So be prepared for those types of questions, mostly.
So we are at 11:46, and we promised time for questions. So I'd like to answer some of the questions that have come in. But first, Adam and Jan, thank you for a great presentation. And please consider that you just received a virtual round of applause from the 350 people that are here. We're going to cover some of the questions we have. I'm sure that time will run out, but we promise that you will get answers to your questions as Mari indicated at the beginning. So the first question that came in, and I'll let either Jan or Adam take it as they choose, is in the discussions with rating agencies and with investors. Excuse me, I've got the wrong question here. In the discussion with rating agencies and investors, you indicate that they so far haven't seen value in this addition. What do you think going ahead? Do you see more value, more perceived value emerging out of this?
Yeah, I don't want to jinx us, but I would say that right now the rating agencies, primarily ISS and Glass Lewis, both have their own methodologies for evaluating pay and performance. And largely they developed those methodologies because there was no standard that all companies used. So they created their own methodology for assessing and comparing pay versus performance across companies. This year, because of the timing of the adoption and implementation of this, neither ISS nor Glass Lewis really had time to decide whether or not this would be a viable replacement for their methodology. So they both basically ignored it for this year. I think the jury's still out as to whether or not they will continue to ignore it. Doing that pay for performance analysis creates obviously extra work for ISS and Glass Lewis's staff. So it's conceivable that they could look at this new SEC disclosure and say, great, we'll just use this instead. And that way we don't have to do the work anymore. If that happens, this new PVP disclosure will all of a sudden become much more important than it was this year. On the other hand, they may look at it and have some of the same and see some of the same flaws in it that we see and prefer to keep their current methodology. TBD, but I think the importance this has to the institutional shareholders will be heavily swayed by whether or not ISS and or Glass Lewis adopt it in their evaluation methodology. Adam, I don't know whether you feel differently about that.
Yeah, no, I completely agree. I think it's in the best interest of ISS and Glass Lewis to keep their own methodologies. And I think they would argue that they use consistent methodologies across companies, whereas with companies doing this themselves now, it's up for them to select the valuation methodologies in line with what they use at Grant. So I don't think we'll see increasing interest from the rating agencies in this over time. I think they're just going to tabulate the results in the report and continue to stick with their own methodologies. But as Jan said, time will tell on that.
Thanks to both of you. The next question is a good one, and it's technical. Is the TSR metric on the PVB table the TSR for the specific year in question, or is it the metric meant to cover a multi-year period, the 2 migrating to 5-year period that disclosure will ultimately roll out? Which is it?
It's indexed. So much like your 10K graph, you start with $100 and you're looking at the value of that investment in $100 at the end of each of the 3-year periods. So it's starting at 12/31/2019, investing $100 in the company and in the peer group, and looking at that value at the end of each of those 3 fiscal years.
Thanks. A related question is, and this relates to emerging growth companies. How many years of data are required for emerging growth companies? Are the rules different, or are they the same?
The answer is 0. Yeah, thankfully they're exempt.
Yeah. So there's kind of 3 tiers. There is emerging growth companies, which are exempt from this PVP disclosure entirely. There are small reporting companies who still have to do a PVP table, but it starts out with only 2 years of data, not 3 years of data. And then there are, the not small reporting companies, the rest of us who had to comply this year with 3 years, next year 4, the year after that 5.
Thanks. Another technical question. What about dividends and the treatment for those, and specifically dividends that are not paid in cash, prior to the vesting date, but are accrued and are paid with the equity award? Is this treated as paid when they're first accrued with a later adjustment if the award was forfeited or not paid, or how is it treated?
So to the extent you're not accounting for the dividends in the valuation on your grant date, you have to report them separately. So if you think about it, like a lot of time companies that pay cash dividends at the same time as shareholders, you got to put that in a separate line item for dividends.
But I think, there, just to kind of beat the horse on that one. So even though you may not have paid the dividends, so you're accruing the dividends for future payment upon the ultimate vesting of the equity, those accrued dividends would still count in the year of the accrual, because it's the same concept of that, mark to market value, where you're saying, even though the equity hasn't vested, I still have to account for the change in value over this fiscal year in the unvested value. And so dividends would kind of fall into that unvested value accrual.
Thanks. I have one more question, and it's interpretation of the data. Is your data showing that the PVP disclosures show even greater alignment between pay and performance than the data that we're used to with the summary compensation tables that show the alignment on the scatter diagram? What this appears to say is the alignment is actually higher than what ISS data typically shows. Is that a correct read or incorrect?
I will give a short one-word answer to that. Yes, it is. Definitely shows greater alignment, which makes sense if you think about the fact that what's in the biggest chunk of what's in the summary comp table number is equity grant value, which bears no relationship at all to what that equity is ultimately worth. So the fact that the PDP table is capturing what that equity is ultimately worth, it makes sense that it actually shows a much stronger alignment.
Thank you. That's all the questions I have. I'm going to turn it back to Mari for any closing comments or questions.
Great. Thank you so much, Steve, for helping moderate this conversation. And Jan and Adam, so many great insights for our board directors. If we can go to the next slide, I just want to take a moment to invite everyone to participate on our next webinar, and that's taking place on August 8th, and that will be at 2 p.m. Eastern Time. You can register on our NACD webinars link or on the Perlmeyer link that you see below, on the NACD events page under webinars. As I mentioned at the very beginning of this session, all of our webinars are archived, and you can find those on the nacdonline.org webinars or on the perlmeyer.com/knowledge-share. If we didn't get to your question, or if you have a follow-up question, please feel free to connect with us and contact us, and we'll make sure that one of these amazing experts will get back to you with an answer, or that we get those answers for you. On the next slide, I just want to remind folks that you are receiving 1 NACD credit towards maintaining your fellowship or certification. And if you have any questions about either of those programs, please visit us at nacdonline.org, or you can contact one of these two folks, credentialing at nacdonline.org, just to find out more. And then finally, I just want to take a moment. Thank you again, Steve, Jan, and Adam. You did an amazing job. To our audience, before you go, just remember that on the screen, you'll get a pop-up with asking about an evaluation. We'd really appreciate you just take a couple of minutes and answer these questions. And that concludes our program right before the hour. So thank you for joining us, and we'll see you on August 8th.
Thanks, everybody.
Thank you.
Thanks, everybody.